I'm V. Sirisha, Associate Professor, Government City College. Today's topic is Financial Statement Analysis. Techniques of Financial Statement Analysis. Here we have important methods of financial statement analysis. They are comparative statement or comparative financial and operating statements. So about these things already we have discussed. Now coming to the second method is common size statements. So what is the meaning of common size statements? So it is a vertical presentation of financial information is followed for preparation of common size statements. Besides, the rupee value of financial statement contents are not taken into consideration, but only percentages is considered for preparing common size statement. The total assets or total liabilities or sales is taken and the balance items are compared to the total assets, total liabilities or sales in terms of percentages. Thus, a common size statement shows the relationship of each component to the whole. Separate common size statements is prepared for profit and loss account as common size income statement and for balance sheet as common size balance sheet. Here we have common size balance sheet. Again I'll explain. A common size balance statement will be facilitates comparison of financial statements of not only a single firm over a time period but also comparison of financials of different companies for a given time. Under this method, all the items of the statement are presented as percentages or ratios of a particular item. Therefore, even if the related absolute figures are in respect of vastly different scale of operations, a common base for comparison is created. In case of a common size income statement, all items are presented as a percentage of net revenue. A common size balance sheet shows each item as a percentage of total assets. A common size statement helps in determining the relative efficiency and soundness of a firm and helps in understanding its financial strategy. Now, what is the importance of common size statement? One of the benefits of using common size analysis is that it allows investors to identify drastic changes in a company's financial statement. This mainly applies when the financials are compared over a period of 2 or 3 years. Any significant movements in the financials across several years can help investors decide whether to invest in the company. For example, large drops of a company's profits in 2 or more consecutive years may indicate that the company is going through financial distress. Similarly, considerable increase in the value of assets may mean that the company is implementing an expansion or acquisition strategy, making the company attractive to investors. The next one, the common size analysis is also an excellent tool to compare companies of different sizes but in the same industry. Looking at their financial data can reveal their strategy and their largest expenses that give them a competitive edge over other comparable companies. For example, some companies may sacrifice margins to gain a large market share, which increases revenues at the expense of profit margins. Such a strategy allows the company to grow faster than comparable companies because they are more preferred by investors. Preparation of common size statements. In case of company statements, common size statements are prepared with the help of 5 columns. As here, common size balance sheet, assets are classified into categories such fixed assets, investments, current assets and fictitious assets for 2 years under consideration. Furthermore, liabilities are classified into categories including proprietors fund, long-term loan and current liabilities. Thus, a total of assets or liabilities is taken as a common base equal to 100. These amounts are specified in column 1 and column 2 of the common size balance sheet. Each item on the asset side is taken as the percentage of total assets. Similarly, each item on the liabilities side is taken as a percentage of total liabilities. The formula used to calculate such a percentage is as follows. That is, percentage of base is equal to individual item amount divided by base item amount, that is in brackets total assets divided by total liabilities in case of balance sheet into 100. So this is how with the formula it will be calculated. In case of preparation of common size income statement, specify the absolute figures of each line item of the income statement for 2 accounting years under consideration. These amounts are specified in column 1 and column 2 of the common size income statement. Choose sales amount as the common base. Sales amount we will be taking as the common base. This is equal to 100. Calculate base year percentage for each line item using the formula, that is percentage of base is equal to individual item amount divided by base item amount, that is sales in case of income statement. So here base item amount is sales into 100. So this is how you will be calculating the base year percentage. So now once again I'll go through the explanation how to prepare the common size statement. So in case of comparative statements, common size statements are prepared with the help of 5 columns. The first column contains details of particulars. For example, if a balance sheet is being common sized, all the line items forming part of the balance sheet are reproduced. In the second and third column, amounts pertaining to the line item in the current year and the previous year are written. In the fourth column, we convert the absolute amounts of the column 2 pertaining to the current year into percentages. In case of statement of profit and loss account, amount pertaining to each line item is expressed as a percentage of net revenues. And in case of balance sheet, amount pertaining to each line item is expressed as a percentage of total of balance sheet. And in the fifth column, the absolute amounts of column 3 pertaining to previous year into percentages. So thus column 4 and 5 present the financial statements of 2 periods to a common base. This helps to understand the change in composition of the statements. Now coming to the advantages of common size statements. Here, what are all the advantages of common size statements? Common size statements. First advantage is easy to understand. It is easy to prepare and simple to understand. Here, common size statement will be helping the users of financial statement to make clear about the ratio or percentage of each individual item to total assets divided by liabilities of the firm. For example, if an analyst wants to know the working capital position, he may ascertain the percentage of each individual component of current asset against the total assets of the firm, and also the percentage share of each individual component of current liabilities. So, here figures of each component of the statement are converted into percentages. It is very simple for the user to understand. Now, second advantage is helpful for time series analysis. Here, time series analysis is a common size statement helps an analyst to find out a trend relating to percentage share of each asset in total assets and percentage share of each liability in total liabilities. So here, common size statement enables analysts to compare how each component of the financial statement is behaving over the years. Thus, can be effectively used for trend analysis. Coming to the third one, comparison at glance. Here, an analyst can compare the financial performance, that is percentage of increase or decrease of each individual component of cost, asset, liabilities, etc. are available, and he can easily ascertain his required ratios. Coming to the fourth one, helpful in analyzing structural composition. Here, a common size statement helps the analyst to ascertain the structural relations of various components of cost or expenses or assets or liabilities, etc., to the required total of assets or liabilities and the capital. So, here it clearly brings out the importance of each line item in the overall performance. For example, a finance manager can pinpoint to the areas that need to be looked at. It profitability is to be improved. There is no point in putting in a lot of effort to reduce cost. That is only an insignificant percentage of the revenue. Thus, management's efforts are channelized better. It also facilitates both inter-firm and intra-firm comparison. Common size statement will be acting as a tool, can be deployed for both inter-firm and intra-firm comparison. Coming to the limitations. What are the limitations? Common size statement is not free from some of the limitations. First one is standard ratio. Here, common size statement does not help to take decisions since there is no standard ratio or percentage regarding the change of percentage in the various components of assets, liabilities, sales, etc. Here, meaningful interpretation of common size statement can be made if they are compared with an ideal or a standard breakup. Establishing such standards is difficult. time consuming and expensive affair. So this is one of the limitation. Change in price level is another limitation. So here common size statement does not recognize the change in price level, that is inflationary effect. So it supplies misleading information since it is based on historical cost. Third one is following consistency. Consistency in the accounting principles, concepts, conventions is not maintained in the common size statement, becomes useless. Next one is seasonal fluctuations. Common size statement fails to convey proper records during seasonal fluctuations in various components of sales, assets, liabilities, etc. Examples: sales and closing stock significantly vary. Thus, the statement fails to supply the real information to the users of financial statements. Window dressing. Effect of window dressing in financial statement cannot be ignored, and common size statement fail to supply the real position of sales, assets, liabilities, etc. due to the evil effects of window dressing appearing in the financial statements. Qualitative element. So these statements fails to recognize the qualitative elements. Example: quality of works, customers' relationships, etc. While measuring the performance of a firm, although the same should not be ignored. Liquidity and solvency position. Liquidity and solvency position can be measured by common size statement. Cannot be measured by the common size statements because it considers the percentage of increase or decrease in various components of sales, assets, liabilities, etc. In other words, it does not help to ascertain the current ratio, liquid ratio, debt equity capital ratio, capital gearing ratio, etc., which are applied in testing liquidity and solvency position of the firm. And some more limitations are focused on past performance. Here, comparative statements, common size statements are also focusing on the past. They are not future oriented and they does not provide reasons. Common size statements do not explain as to why a particular component has a higher or lower percentage over the other component. Common size statements need to be supplemented with other tools of analysis to make proper interpretations. So there need to be a standards. Limitations of financial statements. These are the limitations. Coming to the end of the topic.